The biggest enemy of your investment success isn't market crashes, inflation, or even bad companies. It's your own brain. Today, I'm going to show you exactly how your mind tricks you into making terrible investment decisions and the one simple strategy that can save you from yourself. But first, let me ask you something. Have you ever bought a stock when it was flying high, only to panic sell when it crashed? Or maybe you've been sitting on cash for months waiting for the perfect time to invest. If you're nodding your head right now, you're not alone. And more importantly, you're not stupid, you're just human. I'm Dipom, and over the past several years of studying behavioral finance and analyzing market data, I've discovered that successful investing isn't about picking the right stocks or timing the market perfectly. It's about understanding the psychological traps that destroy wealth and having a system to overcome them. In this video, I'm going to break down the 3 biggest psychological biases that are costing you money, show you real market data that will shock you, and give you a bulletproof strategy that legendary investors like Warren Buffett swear by. I guarantee by the end of this video, you'll never look at investing the same way again. Let's start with a simple question that reveals everything wrong with how we think about money. Imagine you have 2 choices. I can give you 1,000 right now, or you can flip a coin where heads gets you 2,500 and tails gets you nothing. Which would you choose? If you're like 90% of people, you chose the guaranteed 1,000. But here's the crazy part. Mathematically, the coin flip is worth 1,300 on average. Your brain is literally wired to leave money on the table. This is called loss aversion, and Nobel Prize winner Daniel Kahneman proved that we feel losses twice as strongly as equivalent gains. In investing, this means you'll hold on to losing stocks too long, hoping to break even, while selling winners too early to lock in profits. Now, let me show you the second trap. Look at this chart of the S&P 500 during the 2008 financial crisis. If you were investing in late 2008, your brain would be screaming, "The world is ending, get out now." But here's what actually happened to someone who kept investing. They would have made a fortune. But recency bias makes us believe whatever just happened will keep happening forever. Bull markets feel like they'll never end, and bear markets feel like the apocalypse. Before we dive deeper, if you are finding this valuable, hit that like button and subscribe for more behavioral finance insight. It really helps the channel grow and reach more investors who need this information. Which brings us to the third trap, the market timing fallacy. Raise your hand if you ever thought, "I'll just wait for the market to drop before I invest." Here's the brutal truth. Missing just the 10 best days in the market over 20 years would cut your returns by more than half. And those best days, they usually happen right after the worst days when your brain is telling you to run for the hills. So how do we beat our own brains? Let me show you the weapon that's been hiding in plain sight. Dollar cost averaging isn't just an investment strategy. It's a psychological hack that turns your brain's biggest weaknesses into your greatest strengths. Instead of trying to time the market, you invest the same amount at regular intervals, no matter what's happening. Let's look at real data. During the bull market from 2009 to 2018, if you had invested 1,000 every month using DCA, here's what would have happened. You would have invested 1,20,000 total and ended up with approximately 1,80,000. That's a 54% total return, or about 4.8% annually on top of market gains. But here's the kicker. You never had to make a single timing decision. Now let's look at the scary part, bear markets. During the 2008 financial crisis, DCA investors actually came out ahead. Here's why. When prices dropped 50%, your fixed 1,000 bought twice as many shares. You were literally buying more when everything was on sale, while emotional investors were selling at the bottom. But what about sideways markets? From 2000 to 2010, the S&P 500 essentially went nowhere. Lump sum investors made almost nothing, but DCA investors still came out ahead because they were consistently buying at different price levels, smoothing out the volatility. Let me show you 3 real companies to make this concrete. Apple stock in 2008, $25, Tesla in 2019, $50, Netflix in 2012, $10. If you had been DCAing into these during their scary periods, now you might be thinking, this sounds great, but how do I actually do this? without messing it up. Let me give you the exact blueprint. The 4-step DCA system. Step 1. Automate everything. Set up automatic transfers from your checking account to your investment account. The moment you have to think about it, your brain will find excuses. I personally have $200 transferred every month on the 15th, no exceptions. Step 2. Choose your frequency. Monthly is perfect for most people. Weekly can work if you are paid weekly, but don't go daily. Transaction costs will eat you alive. The key is consistency, not frequency. Step 3. Stick to broad market funds. Individual stocks can still be too volatile for DCA. Stick to broad market ETFs like VTI or SPI. You're buying the entire market's growth, not gambling on individual companies. Step 4. Never stop. This is where most people fail. They DCA for 6 months, then stop when the market gets scary or when they get a bonus and want to invest it all at once. The power of DCA comes from decades of consistency. If this strategy is making sense to you, make sure you subscribe and share this video with anyone who's struggling with investment timing. Now let me show you the real power of consistency. I started DCAing in 2021 with just $200 per month. Today that automated system has grown to $8,000 without me having to make a single market timing decision. The best part, I sleep perfectly at night. If this video just changed how you think about investing, I need you to do 3 things right now. First, smash that like button. It tells YouTube that this information is valuable and helps more people discover it. Second, subscribe and hit the notification bell because I'm releasing a complete series on behavioral finance that will transform your investment results. And third, comment below with your biggest investment psychological trap. Is it loss aversion, recency bias, or market timing? I read every comment and I'll help you build a strategy to overcome it. Next week, I'm breaking down how to build a dividend growth portfolio using the same behavioral principles we discussed today. You won't want to miss it.